Okay, almost set. Box, yeah, they will be driving soon. Yeah, that'll be the day when I'll be done with my Uber duty. I mean, the best part when my elder one comes back home from college is, she can drive the younger one around wherever she's needed. So as a parent, we get a break. That's the best part of it. But yeah, until then, we gotta do what we gotta do. That's our job. Doer, yes. Yeah, someone asked, so it's a real story. During, in an office, someone asked me, okay, what are you gonna do? I said, I also Uber in the evening. They say, really? I'm like, yeah, I have a two, and it's like, I'm talking about 4 or 5 years ago. I said, I have a 2 permanent customers that I need to drop. And then they realized what I was talking about. So yeah, this Uber for a few more years, I gotta do Uber. Sam said it was not positive, not at home to experience for 2 weeks. Not sure, Sam, what are you referring to? All right, but I'm back. Glad to be here. And as always, we'll look into what's going around in the market. And I also want to dig deeper into one of the topic that I think I touched upon last week was the inner workings of stock market. That was a fascinating read for me. So eventually I got some time to finish that this week. So do want to share. I learned a lot in terms of how the market works. And, 2 weeks ago, we saw volatility in the NYSE. So it was good to understand that. Oh, Sam, you're referring to the market is not positive. Yeah, Disney and Amazon didn't have the best of their weeks. I think Disney was still did good. Their earnings were okay. Yeah, we'll dig it deeper into Disney earnings. Amazon we covered last week anyway, but yeah, I will talk about Disney. What I saw as Disney and how I think it's maybe since last quarter I changed my opinion of Disney. So, and it's good to see Disney coming back to doing the right things for shareholders. So yeah, we'll look at some of the earnings. Definitely look at Lyft and Uber and how 2 companies in same industry, completely different results when it comes to stock movement and also when it comes to the business side. Right? So this is where I would say the micro, those who invest based on microeconomics. I don't think there's something called micro investor. There is a term called macro investor. And when it comes to the macro investor, they don't care whether it's Coke or Pepsi, whether it's Lyft or Uber. We look at the overall macro picture. But this week told and showed that two companies in same industry, printing in completely 2 different results, and stock market behaved very differently for both of them. Yeah, so we'll look into some earnings results, and always floor is open for any questions, anything you want to talk about, you want to bring up for discussion. Let's do that. All right, with this, anything else you guys saw in the market? There's a lot. Any other things that you noticed? Any other companies? Okay. All right. No feedback. So let's move on. Let's, as always, well, first we'll look at the macro side of the house. See what happened. Nothing. I mean, it's as usual. Market giveth, market taketh. 1 week it's up, other week it's down. This whole 2023 has been great for the stock market. I would say unusually great, and we talked about in every week, right? You got the returns what you generally get in a year. You got those returns in first 2 to 3 weeks of the market. So it is but natural that market will give out some of its those gains, and that's what we saw this week. Overall, market ended a little bit lower, but still, I think it's the 2023 year to date, still a great return so far, right? The other thing that caught my eye, and this I didn't see too much in the news, not many people were talking about, was the CPI number got revised. I mean, if you go back to the previous week when the CPI numbers were announced, and the number came at negative 0.1%, right? And that's what caused markets to swoon, saying, all righty, now the inflation has started to decline. Now the Fed will start to pivot. And then Fed came, and Fed obviously wasn't too hawkish. Fed didn't became too hawkish. So market assumed, okay, it's going to be dovish. They're going to pivot. But all that was driven by the fact that inflation is easing, because inflation number came out to be negative 0.1%. But this Friday, that number got revised. Now the new number is actually positive 0.1%. So we ended up in a difference of 0.2%, but this wasn't much talked about. I don't know whether some of the Friday reaction that we saw, market going down, was because of the inflation. Actually, it was not a disinflation. It didn't decrease a little bit. It actually is still ended up positive. So instead of a decline, it actually increased, and that number was revised. But anyway, so I think from my perspective, still the same market had spectacular returns, especially in some particular segments, tech sectors, growth companies, especially NASDAQ. NASDAQ has seen the returns not seen in decades. Other stats that I heard was the difference between the NASDAQ returns and the Dow Jones returns. We'll see where the Dow Jones, or maybe we should jump over there and we can come back to some macro charts. So Dow Jones is up 2.18% year to date, and NASDAQ is up 12%, almost 12% year to date. So the difference is almost 10%. Last time this difference was seen, such a wide disparity between the Dow Jones return and the tech focused return, was in 1999. In the month of January. No, I'm not sure if it was a month of January or in a particular month, when Dow Jones and NASDAQ had such a gap in returns. So, but obvious that some of these gap or the NASDAQ, the run up that we saw in NASDAQ stocks will be given up. Okay, I see a comment which says all due to chip stocks. I would rather go one level further down and maybe say all due to AI. Right? Yes, right. We saw a lot of. Let's see. Let's pick up some of the chip stocks, especially players like NVIDIA and all that. Oh, what a run they have, and I think they'll continue to have that run. So let's bring that up. All right. So this is where the stock of NVIDIA. Right. At some part of a time, this stock used to be what, $300? I don't know. I am only a recent investor in NVIDIA. Oh yeah. So it almost 350. some part of time. At the peak, it was 350, fell all the way down to 125, lost more than 60-70%. And now since the start of a year, right, from 2nd or 4th of Jan, it is from 140. It is almost, it closed near $200. So that's a decent amount of jump on NVIDIA. And if you go back to October, from its October low, it's almost doubled. Okay. Yeah. So I started building position in NVIDIA only during this time frame. So probably bought here. I don't know. I'm allowed to go back and check. But yeah, I started building position in 2020, basically last year, 22. But been a happy shareholder since then. So yeah, and majority NVIDIA is one. I think I didn't check where AMD is. I don't hold AMD in my portfolio. But yeah, we saw some decent gains in AMD as well. I guess all of them is driven by the AI. AI is the new .com. And to run those AI models, you need to have a stronger and stronger chips. NVIDIA specifically got a big boost because their chips are specifically designed to run a lot of these AI workloads. So we go back and when was the last time we did a deep dive on NVIDIA? It's been a few months. So, but I recall there were a few sectors in which NVIDIA was very focused on. One was automotive, other one was gaming. The data center, then the gaming, and the fourth one was the AI. So some of the chips that they make are specifically designed for AI workload. Crypto, I think after the initial bump, the crypto, after they changed, not a big one because they actually changed their chipsets so that you can't use their GPUs, which were used for gaming, for crypto. So I think they, because crypto would have been would have added a lot more volatility to their earnings profile. And that was a concern from investor. And the fact that in 2000 and not 2000, what am I talking? 2020 and 2021, we saw a lot of those crypto miners, lapping up those GPUs, which a lot of gaming companies and gamers used. So that was a concern from the market in terms of if the main core industry, which was their gaming industry, if that doesn't, that's being stifled because of this crypto, which is a volatile sector. So they did make a change in their chip, so that if you want to really mine Ethereum, that was mostly around Ethereum. If you really want to mine Ethereum, it was no longer feasible to do it on a general GPUs. So they made a change. It didn't run those calculations faster enough. In any case, now the Ethereum mining since then had already switched to proof of stake. So now that whole proof of work mining is gone there is no need for it. So I'll maybe next, when did NVIDIA report results? Why am I not seeing? Maybe when we'll see NVIDIA reporting result, that time, maybe we'll do a deep, they already reported a while ago. Okay. Oh, sorry, this is AMD, NVIDIA. Did they already report? No. Okay, so they'll report results around 22nd. So maybe we'll do a deep dive into what their segments are. Yeah, but yeah, this stock had a great run because of crypto. And then I think had a great run in the opposite direction when the crypto market crashed. So they kind of not de-risk themselves from it. Yeah, but it's been I think it's a lot more on the AI front. And to me, gosh, this gives us signs of 2000, right? Anything you add .com behind your company name, you'll see a jump in the stock price. Same stuff is happening with AI. Um, if you add AI, it works out good. You'll see a couple of $1 billion added to your market cap. If somehow it fails, and we will talk about $120 billion wiped off from the market cap of one of the biggest market company on on US stock exchanges. I think too much over enthusiasm, too much exuberance right now in AI front, just because of ChatGPT came along, right? So I'll be careful if I'm investing in any one of these companies because of AI. This craziness can't continue for long. Always these things will come back to normalcy. All right, so far, saw another interesting chart. Is what's been working. Inflation continues to moderate, which is right. It is still way higher than where Fed would want it to be. Fed's target is 2%. But if we have to believe Howard Marks in his, the third big sea change, probably we should forget about 2%. Or maybe I think probably Jerome Powell should forget about 2% as a normal. And maybe we should look at a new normal, which could be 3%, 4%. Right? But I'm in no position to say what Fed would think. But anyway, we are seeing some tapering down and easing of inflation this year, and that's all market has been expecting. And based on that, the market expectation of the Fed hikes is also probably 2 more hikes. You do another hike in March, another hike comes in May. And that's then probably no more hikes. Stable. Right now, this is what market is pricing in. And then in the Q4, in the last part of 2023, market started to expect that Fed will start to cut rates. We should see the pivoting coming from Fed. Now, whether it will happen or don't happen, no one knows right now, but this is market has been pricing in. If you go and look at the bond market and the futures on Fed funds, this is what you're looking for, right? And so far this year, bond market has been correct. I mean, irrespective of whatever we saw Fed governors and Chairman Jerome Powell talking about it, but bond market is already dictating that, guys, we'll get no more than 25 basis points, and we got 25 basis points. So far, at least for last 6 months, bond market has been I would say a leading indicator of what the Fed funds rate is going to be. And right now, market is expecting this. Anything change here, market will react. We should see a big reaction coming from the market. So what are we talking about? Maybe another couple of 25 basis point hikes. And I think this is the time, maybe if I go by this chart, right? If you really want to go by this chart, assume this is what the correct chart would be. Maybe lock and load your emergency fund, or anything if you want to pick in treasuries or CDs, maybe lock and load around mid of this year. Take a longer term, or probably that's where you get the highest yield. After that, market is predicting in Q4, the Fed fund rates will start to go down. And correspondingly, we should see all other fixed instruments, fixed rate instruments will also go down. Right. All right, that's really on. Okay, so a few more. Jay says, what's the expectation for the mortgage rate throughout 2023? Mortgage rates generally follow your 10-year fund rate, your 10-year rate. So we can look at, I don't know what's the 10-year rate expectation is, but if you're looking at Fed rates to go down, market will also, the mortgage rate should also correspondingly should start to go down. Hold on, let me see if we have a ten-year treasury yield expectation. No, that talks about no. So eventually, I mean, all of these things are driven by the Fed and the treasury rates. I'm not sure if a 10-year, didn't see anything on the bonds. ZN. Generally, I don't deal in future, so no. But we want to see what's the future expectation of this. But the common knowledge is if Fed is going down, the mortgage rates should go down. Generally, they track a 10-year treasury, basically 10-year yield. Again, yeah, I'm not much expert on the mortgage side of the house, but that's all I can say in terms of. I don't know what the exact number would be. If we are looking at what it's 5% over here. Right now, where the 30-year mortgage is, 30-year is almost 6%. Right now, the 30 years is almost 6%. Looking at a yield curve. So this yield curve is still the most inverted since 1980s. Right? It has not painted a good picture. Again, if there is any indicator that gives us any idea that a recession is coming, yield curve has been the most reliable indicator. Right? Every time you see a big inversion in yield curve, and you see these gray bands, these are the periods when the economy actually hit a recession. Again, big inversion yield curve, recession, little inversion, recession. Only time when it didn't happen or the recession was very brief was in 2020. And now we are seeing the yield curve is inverted the most in the last 40 years. And that is why, on the financial media, we still see, guys, recession will come in, and the market is not pricing in all that. And we just gotta be cautious, gotta be careful. It's not that, everything is clear for now. But not this week, but the previous week, we saw market behaving as if we got a green signal from economy and from Fed. Is this going to be any different? No one knows. We can't say now, but I'll still be cautious because this never happened that with Fed increasing the interest rates and yield curve inverted by so much that we didn't have a recession. Now, another thoughts going on, and we have heard about a lot of these terms, right? Hard landing, soft landing, no landing, depending on how deep the recession could be, or we may not. If the recession a little deep, it's going to be a hard landing. If there is no recession, it's going to be soft landing. And today I heard a new term, and this is while I was driving back after dropping my daughter. I heard a new term called, rolling recession. And I'm like, I didn't hear about this. What the heck is a rolling recession? So rolling recession, the journalist was explaining that this is where you don't have the whole economy go down, but you have a certain sectors of economy that go down one after another, right? Housing sector has gone down this year. I mean, last, I would say a few months, few quarters, housing has gone down. It's down 20%. And but some of the others, labor, economy, services going good. Tech has gone down, right? Maybe we will, when these start to recover, maybe we will see some, on the services side, that sector going down. So it's not that all the sectors in the economy will go down altogether, but it's going to be a rolling recession. Now, has it happened before? I think he gave two instances where we have seen this rolling recession happened. And I can't recall right now. Oh, I was driving, but so one was in 1970s, but something new to learn is now we're talking about rolling recessions. Will we have a rolling recession this time? I don't know. I mean, we know that housing is not good. Tech sector is not doing good, not just from the job perspective, but also from the earnings perspective, right? Tech sector's earnings have been pathetic. Like companies like Microsoft and companies like Amazon, they are growing at single-digit growth rates, right? So the economy, so tech side business has not been that great. And so that I would say is already kind of running into recession. And but we'll have to see what next sector would be. But if it is going to be a rolling recession, then we may not feel the impact as much as what a lot of people have been talking about, I think, and around the full recession, right? Again, I heard in the market, was it Carl Icahn? Or maybe I think it's Carl Icahn. He took $5 billion of position, a short position in the market, probably by buying some puts, or I don't know which exactly did he take a short position. So let me not, I won't speculate on it, but I did see on a Twitter that Carl Icahn took $5 billion position. I guess probably is buying put because it was mentioned that expires on 17th Feb. So between now and 17th Feb, he is expecting that market, there'll not be a pretty picture in the market between now and 17th Feb. So, which is by the end of next week. All right, so 30-year mortgage, we looked at Fed balance sheet, again, going in the right direction. There's still a lot more ground to cover. And yeah, a couple of other charts. I don't know what else are we interested in. Okay, all right, so another interesting one tweet that I saw was this. The kids at school keep picking on me since dad flagship fund didn't even beat S&P, right? And they even started calling me levered beta boy, right? And mom is consoling, sweetie, you need to understand all that matters for your dad is AUM, right? Asset under management. And this is one of my pet peeve is around these funds are sectorized. As doesn't matter whether market goes down or market goes up. Some of these VCs most of these funds and the VCs is most, you need to be a good marketeer. All you need is AUM, right? 220. That's in a hedge funds. That's a mantra, right? I will always get my 2% management fee. Come with the mutual funds, whether mutual fund go up or down, they will always get their management fee. AUM is the name of the game. So don't get fooled by the fact that hey, a lot more money is being raised by VCs, so maybe the economy may be good, may or may not be. That doesn't matter. VCs will get their management fee anyway. Whether the investments do or not do in a short term, they're gonna make their money through their AUM. I had a very interesting conversation in one of crypto meetup around this week on. We actually dig deeper into what's happening on the grayscale. Sorry, a little bit divergence from our stock market, but we dig deeper and had a lot of conversation around there's a grayscale Bitcoin trust and why they're still holding on to it as a trust and not dissolving it, even though that's being traded at 50% discount, almost 50% discount right now, right? And big reason is AUM. Grayscale makes almost right now it's what $15 billion asset under management and 2% guarantee, like $300 million, just to do what? To just hold Bitcoin in a cold wallet. That's it. Bobby asked, do you have a link for the crypto meetup? It's on a meetup, and I mean, I used to do my own, but I stopped doing it because I got too busy. And but I found another one which is called Austin Bitcoin Meetup. If you go and search on Meetup, okay, hold on, let me do that. Right. It's an Austin Bitcoin Meetup, and one good thing I like about that meetup is so the folks over there have been in this space for way longer than I have been, and they are actually also building some protocols. They are, I mean, the main host of that meetup is a builder in this space. What's happening? My meetup is not responding. Okay, hold on. Let me give a link to you. So I talk mostly, my contribution in that is mostly around investing and what kind of economic value or grift that I see happening in the crypto side. So I dig way deeper into this grayscale Bitcoin stuff and cash and carry trade and why did a lot of these hedge funds, how did they blew up? All right. So yeah, coming back, the reason everyone asks why that fund, and let me just bring that up, discount GBTC, discount to NAV. It's right now, it's at 47%. Sorry, 46%, right? Now the question here is why this is trading at in the market. And by the way, for those who are uninitiated, GBTC is a trust that holds Bitcoin, and this was the only way for institutions to get any exposure to Bitcoin, right? So we saw it in 2022, 2021, this trading at a premium. And since this is a closed-end fund, generally you'll see closed-end funds, whether it's a closed-end mutual fund, closed-end trust fund, they will trade either discount or a premium to the net asset value, basically. In case of a stock market, if that closed-ended fund is holding, let's say, Google stock, which is worth $1 million, it is possible that the mutual fund may trade at a discount to that $1 million, right? Because it's closed end. So this is now trading at 46% discount. So it means the amount of the Bitcoin the value of the Bitcoin that this holds is almost double than what the current price you're paying. So there were we had some interesting discussion, and I dig deeper into it. It's all about the AUM game. If the issuer wants, they can just close this discount by dissolving the fund and giving the Bitcoins to the unit holder, but then they will lose whatever $300 million that is just, for doing nothing, for passively holding Bitcoin. Maybe they'll give it to Coinbase. Some of that will go to Coinbase because they are custodying our Bitcoin, but this whole AUM game, right? Same as the game here in VCs and the mutual funds. All right, let's find it. Coming back to the stock market, looking at all the major indices. So this week, all the indices actually declined, and no surprises. And the ones which had flown way higher declined way more than the rest. We see Nasdaq is down by almost 2.5%, but still pretty impressive run in these indices in 4 weeks, I would say. Not 4. Now we are 5 weeks into this year. So in 5 weeks, 12%. Not bad. 6.5% on SPY in 5 weeks. Oh, that's great, right? So nothing to complain about. Overall, only one sector which we saw ended positive was energy, right? So that is why if you have diversified portfolio, some things will go up, some things will come down. When the market is on risk on, we'll see communication, information technology, and discretionary. Those stocks just go high, and we will see utilities and healthcare come down. When market doesn't want to take any risk, things will be a little different. But energy this week, I think only one news I heard was around Russia. It's gonna cut oil output. That's the only news I heard. And again, I don't actively go and hunt for news related to energy. So if there's anything else that you came across, which could have given like 5%, right? Energy sector is up 5% this week. Do share. I don't know what else could have caused such a big boost in the energy side. But if energy is high, and if oil and crude, basically crude oil, which this is the cost to every other operation. So if energy continues to stay high, then the inflation number should surprise us. The inflation number might go back in, may increase. Something to watch out for. Anything else happened on energy side apart from Russia's news? All right, cool. Next one, fear and greed index, still teetering in greed. I think by next week, if we see another move down in the market, probably this will go back to neutral or something. What else I did? Some buys and sells in my own portfolio. Again, I do want to share in spirit of transparency, disclosure. Yeah, I picked some of these shares. I sold FTX. Because I never read this company's balance sheet. I never tracked this. I don't even know what the name of the CEO is. And then I was like, why do I need to hold this individual company when I have no idea? I know what business it is in. Copper has been doing great. Electrification, EV, but then I had to figure out something else to get exposure to copper than an individual company, because I've never tracked this company. So I thought, I'll part ways with it. Reduces one less ticker to track. And anyway, it was not a too big a position. And if I want, maybe I'll take exposure in ETF XLB, which is materials ETF. And it's, almost 70% correlation to FCX. So a little bit of sale, just because I don't think I had ever tracked this FCX. So this is one thing which I thought in 2023 I will do, is for all the individual companies, individual stocks that I hold, I need to know more about it. One basic thing is I need to know the CEO names of all the companies. And I think now at pretty much, maybe except 2 or 3, I now know the CEO names of all the companies. Who are those CEOs, right? Next thing I want to know is what's the insider, their ownership stake is, right? CEO ownership. So I need to start tracking that and know it. That's how you slowly and steadily you learn about these companies, right? But FCX is something which I don't think I ever looked at its earning results. I never looked at its never read its balance sheet, nothing. So I'm like, okay, I'll do away with it. I'll probably pick an ETF, right? But it's been good so far. Almost for me, it was almost 100% return on FCX. So no complaints about it. ARKK gained due to Tesla, gained credited to Tesla investment. Maybe. So what again? ARKK, instead of me, I think in way back in 2020 or 2021, I had some of these ARKK holdings. Like I had Zoom, I had Invitae, I had few more holdings which also are part of ARKK. I got rid all of them, non-profitable, high growth companies, as my other workload started to increase. And I said, I can't track, so many individual companies. And you guys know, I started with like 110 tickers. Now I'm down to 70, right? So then I decided to start building positions in ARKK and not hold many of those individual tickers. So that's my ARKK right now is my vehicle for what do you call what do you call it? Shooting for the stars, or trying to hit the ball out of the park. So that's, I chose ARKK as an investment vehicle. So position size is accordingly, have my position size based on that. But instead of me trying to hold positions in many individual stocks, which if I can't track it, I don't want to hold it. So that's a theory behind me increasing positions in ARKK. All right. Palantir, you already know. We talked about Palantir earlier. Why do ARK funds trade like a day trader, not hold like investor? ARKK is an active, they are pretty clear that they are active ETF. And they do trade in and out of the markets. Now, why they do it, I don't have an answer to it. I think they're probably trying to beat. Now, whether they will be able to, that I don't know. That only time will tell. But they don't claim to be a passive ETF. They are pretty active ETF.
Vivek.
Yeah.
What I'm saying is the funds, not just ARKK, all the funds, they trade like, I thought if it's going to be good in 5 years, why are the funds trading every day or every month? It's supposed to be for 5 years. What's she doing? Has the fundamentals changed in a week or something? It's kind of, gouging. Yeah, that's the right word.
No, she's always told that it is an actively managed one, right? So we see a lot of, when it's an actively managed, we see a lot of fund managers move in and out. And again, every fund manager have their own theory of how they want to deliver market beating returns, right? I generally try to hold my positions, but I think ARKK, they have a different theory on how they want to do it. But I think there are some tickets, like we do see her coming in and out, like say Tesla, etc. She'll buy it. If it goes down, maybe sell it. If it goes up, I don't know what she does. But I think she's a pretty, Kathy, they have a pretty stable holding on Tesla. There's some of the takers they'll hold for long and keep buying it whenever the dip opportunity comes. On some others, they'll trade in and out of it, I guess. But again, I think each fund manager have their own way to trying to beat the market. And for ARKK, but I think they can actually do better than the market by trying to time the market. But good luck to them. I don't have a time or the capability. I'll be pretty open to time the market. So I look at other way to beat the market, which is buy great companies, hold them, reduce the cost basis, and those are my go-to vehicle for trying to beat the market over long term. Cool. All right. Next, want to jump into earnings. Oops. Is audio still clear? Hello. Tech check is okay. Okay, all good. All right. Okay, so let's jump into, I think I have 3 or 4 earnings, and then we can pick any other which you want to. So let's talk about Pinterest first. Let me just bring up the Pinterest. All right, any shareholders of Pinterest? I want to hold Pinterest in your portfolio. All right. Anyway, quick update on Pinterest. Can I zoom more into this in web mode? Yes. Okay. There we go. All right. Come to the summary later on. So the revenue grew 4%. Quarter over quarter. That's okay. What I liked is around monthly active users. They actually had a good growth in monthly active users, which was again 4%. GAAP net loss 96 million. That's fine. Share buyback. They also gonna do a share buyback up to $500 million. I think this is in response to a lot of buybacks that we are seeing happening in other stocks. Also, no Microsoft. I don't want to give you my perspective right now. I'm in the middle of a session. Okay, so if you look at from revenue 4% up, monthly active user 4% up, ARPU, which is average revenue per user, is up 1%, and non-GAAP cost and expense up 27%. Business metrics, the only thing which I saw good was around MAUs. Growth is coming back. Previous quarter, when did we analyze? Previous quarter, we actually saw MAU were down 9%, which was a cause of concern, right? When you're in a social media company, you would want to see your MAUs growing, which is active users growing. But not last quarter, 2 quarters ago, we saw it coming down. So now they are back in terms of getting to MAU growth. Balance sheet, almost $3 billion on balance sheet, which is, and almost no debt, no long-term debt, so which is good. So decent assets on balance sheet. Looking at a cash flow, they also have almost $470 million worth of cash flow coming from their operations, but I don't like it because all this cash flow is sponsored by the stock-based compensation. Stock-based compensation is $497 million. And if that was not the case, it would have been a cash flow negative operating company, right? If market doesn't improve and employees start to demand more cash as a part of their salary and not stock options, then they'll have a tough trouble in still generating a cash flow right now. Because right now, all the cash flow and more is coming only from a stock-based compensation, not that the operations is really good. So while at the at a high level, the picture looks good. On a headline number is good that they are generating $470 million of cash flow. Remove 30K from this, 30 million from this, maybe $440 million of free cash flow, but all of it is coming from stock-based compensation. Also, from management side, when you look at their slides of management business outlook, I didn't like it because I didn't see any new product feature, any announcement. So does that mean the pace of R&D has come down? I don't know. We'll have to see what happens in future, right? So they're focused on growing monetization per user, which is right, which is good, and a couple of changes in the management leadership. A CFO is out, and probably they'll have to hire for a new CFO, and the chief marketing officer, chief revenue officer will now report to chief executive officer. I kind of like this. They got a new CEO a few quarters ago, and I think, yeah, so far he has produced, and he has given results, and should be free to choose the people that he wants to work with. Maybe he's going to build his own, new leadership team. So I'm not much concerned about this, but yeah, I think I'll still give them a few more quarters to continue. This is a company which is, from my perspective, a social media company which has got a lot of potential when it comes to advertising and shopping, and they haven't been able to encash that just yet. They have almost how many monthly active users? 400 million monthly active users. What's the number? Yeah, 450 million monthly active users. So it's kind of big, more, I mean, it's even bigger than Twitter. So they have to, and other thing is that customers actually go there with an intent to purchase something, or the intent to get an ideas for some activities that they want to do, right? So the next one will be how to convert those ideas. When you've given them an idea of this is how you would organize your room, now how to buy all those things, right? So it's an easy to connect those dots, and we should see Bill Reddy, who's the CEO, coming and trying to make money out of that business. So I'll still hold it. Yeah, so this is my outlook for now. Is I think it's okay. I'll keep it. I'll sell Strangle, acquire at a lower cost, or keep reducing the cost basis. It's still higher than my cost basis, so I don't have any concerns on it. So that's Pinterest. Company is still on the right path, I would say. So I have no concerns on Pinterest as of now. Moving to the next one is a tale of two businesses. I think during the start, we did talk about it, Lyft and Uber, both in ride-hailing business, but stock market giving completely different treatment to these companies. So Lyft was down 30, okay, this chart is wrong. I think it was down 36%. Maybe eventually ended down 25%. Oh, sorry, I'm looking at not 1 month. Oh, I should have looked at 1 day. I think it closed down 30 or 36% after earnings. It's a brutal day for Lyft, right? Not that the current quarter was not that bad, but I think their guidance was what killed them. So based on the guidance that came from Lyft, they are not even, the ridership numbers probably won't even return to pre-pandemic level. Whereas when you compare it with Uber, their ridership numbers are doing better than pre-pandemic level, right? So guidance are pretty weak. They are continuing to bleed money, which is of course the case with all of these companies which had survived on VC funds and then on public market. But with a tightening in the public market and no more free money, no more, you can't raise or take a debt. Even if you want to do a debt financing, it's not available at a cheaper rate. Market is it's not forgiving such companies, I would say. So we see the stock got really punished. I don't know what else Lyft can do. Probably, maybe it is, I mean, that's like end of the game for them. Right? The only business that they have is ride hailing, and their competitor is doing much better than what Lyft has done. I don't know what price point did Lyft come to public market. What was the Lyft IPO price? $72 per share. And as is the case with many of these companies that we are seeing, is came to public markets at very lofty valuations, and now have given up all of them. So especially, I think the lesson that I'm learning by looking at this market is, if you have a lower interest rate environment, and if you are picking post IPO companies, we have to find a way to aggressively reduce our cost basis, because all those valuations are really high. We are actually buying these companies at really high valuations. Lyft came at 72. Right now it is at $10. So what it lost, 85% of its what is this lost? 80% down from its IPO price. Right? That's brutal. Pisheng says, I use whichever is cheaper. I don't think customer have preference between the two. Uber make more. Yes. So we will talk about Uber, and that is why I hold only Uber in my portfolio, not Lyft. But you're right. There is almost zero loyalty to when it comes to ride hailing. Most, including me, I have both Uber and a Lyft app on my phone. I'll see which one is cheaper, or which one, I don't have to wait more, depending on what kind of, what's my need is. But we have a zero loyalty when it comes to ridership. And people, and even I think post-pandemic, both our companies increased the rates. And now in January, both our companies have cut down the rates. And you just can't fight on rates. Any business that is built on cost advantage, where you are trying to cut down your competitors on cost, if that's the only advantage that your business has, if that is the only moat, then that moat is fickle. And that's what we're saying. I mean, how deep you can cut. Anyway, Lyft has already done a round of layoff. They also announced more cost cutting during the recent earnings result, by moving a lot of more jobs to cheaper locations. But you can't do anything more. They are providing more incentive to the riders to attract them. But how long can you fight against on the cost platform? So right now it's a tough situation. Again, I have a very if I were to say, if I had to take a very wild guess on Lyft, I think maybe some food company, food delivery company, might acquire Lyft or collaborate with Lyft, or form a joint alliance or something. I don't think it can just survive based on just moving people around. They have to find another business model. So, but I think DoorDash or Instacart. Tony Zhu, is it from DoorDash or Instacart? He told he's not interested in Lyft, but we'll have to see. And what surprised me, was just after the stock market behaved and punished Lyft stock. We saw lot of analysts, they downgraded the Lyft stock. I mean, like, dude, Mr. Analyst, the only job you have is to analyze the company and give a price target. If you don't even know, and you have to, you are doing everything after the fact, then what's the point? That is why I keep on saying, I don't think no one knows what's going to happen to a company in short term. Even this analyst whose job is 24/7 is only to predict and analyze the company and give price targets. If they can get it so wrong, then you and me don't stand any chance. And that is why I mostly refrain. Someone asked me, where do you see this market going end of a year? I have no idea. Or where do this stock will go? I can talk a little more about the business, and that's what interests me in talking about. Maybe let's look at from business. Stock price, no one knows. And now, I think after the Lyft announcement, we saw many Wall Street analysts coming back and cutting down their price targets, right? Dude, market is already done. Now you don't have to do it. You're just following the price, which is strange. These people get paid, I guess, huge amount of dollar. I mean, they get paid big bucks to do one job.
Vivek,
is so difficult. Yeah.
Big question. I'm from Shanghai, right? Or I lived in Shanghai for a while, and I see those like maybe a dozen food drivers. I mean, the people earn about less than average, but so I'm kind of wondering how Uber would earn money from sending food. I mean, people go to McDonald's. I mean, who in the hell would want to pay delivery food? If you go to McDonald's, you're trying to save money. I mean, it makes no sense. I mean, like I remember in Shanghai, people the app would charge the restaurant like 10 to 15%. And I'm sure they do the same here, but I mean, it's it's kind of like if you have to pay 30% above cost listed.
So here's the deal. I think it's also a generation difference. I don't want to pay. It hurts me if I have to pay and I see the big delivery fee. But let me tell you this. For my kids, this is the way of life. For a younger generation, and it's not just me. In fact, I think it's been a few weeks in our office. I was talking to my co-founder and CTO, and we were discussing the same thing. It's a lot more habitual. Also, it's the generation side, and we don't want to pay. We think that why paying 30% overhead for let's say a Chipotle, why would I call Uber or DoorDash and pay 30% higher price? But the new generation doesn't think twice. From their perspective, it's more convenience, because if I have to go and pick it up and it costs me half an hour, that $5, $10 is not really worth my half an hour, right? So but is it still make money just on food delivery? No. And that is why I think I've said multiple times, if you're delivering, you can't be in just one business. If you're delivering only food, DoorDash, I don't want to own DoorDash stock. If you're delivering only groceries, like Instacart, I don't want to own Instacart stock. Instacart is not public. They're trying to go public, but they're not getting valuation. If you're delivering only people, I don't want to own your stock, Lyft. There is no economies of scale. I mean, it's a very tough business to make money. The only way to make money is to build your business, reduce your per unit cost, and deliver as many things that you can deliver in one trip. So if it is only food delivery, yeah, you're right. Uber is never going to make money. If it is only delivering people, then I'm also scared of that, Uber will not make money. The reason why I hold Uber is what I talked about when I did a deep dive into Uber was, and probably will pick, I'll just perfect segue into how Uber makes money is they got a mobility service wherein they move people. They also built their delivery service just before COVID. I mean, Uber wouldn't have survived COVID if they did not have the food delivery, right? That's what kept the company, the cash coming into the company. And at some point, I mean, it was a bigger business because people were not moving. That was the only business that was working for Uber. And not only this, third one is they are also into freight, commercial freight, right? Uber is working with a lot of companies to move the company's goods. So that's the only reason why I'm Uber shareholder and not Lyft shareholder, because you can't just make money by delivering food, or you can't make money just by delivering by moving people. Number 4 is Uber also is diversified in terms of their geographical reach. Lyft is only US based. Uber is international as well. So combining with this, can Uber make money? I think they can. And that's what even, CEO is trying towards that. And so far, they have been able to keep their promises or their guidance. And right now, they are not profitable. But I think they're aiming for adjusted EBITDA adjusted. No, I think adjusted EBITDA, they already became profitable. But yeah, GAAP profitability, not yet. But I think this company is not going to go anywhere. I mean, we will miss this company. Uber passed my snap test that if I snap my finger and Uber goes out, Uber disappears from face of earth. As a consumer, will I feel something is missing? Yes, I will feel. So that's
Vivek,
why I'm still owner on Uber.
can I give a personal experience?
Sure.
I couldn't get their app on my phone. I didn't have a San Francisco phone number, or I didn't know how to do it. So when they were headquartered in San Francisco, I walked up to their headquarters and I asked for some info. Well, someone did meet with me. I don't know. He was a guard, I guess, because he gave me the telephone number of driver complaints. So am I supposed to have a positive impression of the company if they don't give me the right person?
I mean, so Uber, if for Uber, I don't know, maybe you need to go to the website and find it out. Walking into an office, forget Uber. I actually went into a Fidelity investment office. They couldn't service my request. But then I don't want to hold that against the Fidelity because, hey, the branch office wasn't even equipped to do what I had a question around my business 401 case, and they were not equipped to answer the question. So I was still not, think Uber by bringing in or Fidelity by bringing in my personal experience, but I still look at overall business. So if I look at overall their Q4, the gross bookings grew 19% year over year, right? They're doing approximately 23 million trips. The revenue grew 49%. The revenue almost doubled year over year, right? We will dig deeper because one question which I had was, guys, your bookings grew only 19%. How come you made so much of a revenue? What did you do differently? Because generally they should move in tandem. But then when I looked at their details of earnings, then I realized, okay, what they are doing. Net income is 595 million. So Uber actually made net profit. Sorry, I should take it back that Uber has not made a GAAP profit. They were actually GAAP profitable, right? But I'll discount everything of their GAAP profitability because it was due to equity investment and not by running the operations. So market did good. Their equity investment did good. They were able to show a GAAP net profit of accounting profit, I would rather call, of 595 million. Market doesn't do good. This accounting profit will go down. So we can ignore that. And what else? Looking at free cash flow, they had is $390 million. So let me go a little deeper into what CEO Dara has to say, that 2022 was the strongest quarter ever in the history of Uber. With robust demand, good margins, our global scale and unique platform advantages position us well to accelerate this momentum into 2023. In 2022, we exceeded our profitability outlook with incremental growth margin of 10%. Outlook for gross bookings in Q1 build on that and set up another. Okay. Can't explain anything else. CEO and CFO has to give a brighter picture. So that's what they did. Now looking at their some of the business metrics. Platform customers 131 million. So number of users or number of customers using Uber app increased by 11%. Total trips increased by 20%. And this is what, equivalent to gross bookings. Revenue increased 49%. And we'll talk about that. Now the breakup of the revenue. Mobility is increased 82% year over year. Right? And delivery, which is their food delivery, increased 21%. And freight increased 43%. Now, before we go all gaga over, hey, 82% great in mobility, the revenue increased. The revenue increased because of the business model changes, some accounting changes in the UK side, right? So let's not celebrate too early that the revenue increase that they've shown of 82% may not be all from their operations, right? And this is where I said, I was like, there's a big disconnect. Your bookings grew 19%. Trips grew 19%. I would expect your revenue to grow maybe 20%, 25% if you increased your take rate. But 49%? There's something which I'm missing. And then we'll look deeper and find out, there is something because of accounting change, right? So I'm not going to go and back up my truck on Uber, pun intended. So just be careful when you look at these headline numbers. Sometimes these headline numbers could be deceive. I would say that they are trying to deceive us, but the reality is that these accounting or so last week someone called financial engineering, right, could give us a different picture, paint a different picture than what the real picture of the business could be. Anyway, so same is on the delivery side. But what I like is the freight revenue increased 43%. And freight is a pretty, very, new business. So this new business increasing 43% at a clip of 43%, which is, much higher rate. Of course, they had an acquisition. So we'll have to see, how does this continue from quarter to quarter. Hold on, let me just look at previous quarter. What was it? If I have previous quarter. Okay, I do have freight. Oh, they didn't, a percentage not meaningful. Oh, because they had a 402, then 1751, maybe because again, some other acquisition. Oh, so, okay. So, yeah, so this was acquired, I think. It's not a new acquisition, but just that every quarter its impact is showing up. What I like was around a little increase in the take rate. This is what we do want to see in any of these delivery companies, whether it's Uber, whether it's Lyft, whether it's DoorDash, whether it's Grubhub, that you need to increase your take rate. take rate is nothing but if you are paying $100 overall for your Grubhub meal, out of that $100, how much actually goes to Grubhub? So from an Uber perspective, if you're paying $100 on an Uber trip, they are getting almost 28% of that. So $28 goes to Uber. Or delivery, they get $21. So that's their take rate. However, again, looking deeper into the fine print, majority of this take rate increase came from the business model change in UK. So still not celebrating just now. Almost no impact due to operations. It's not that they had suddenly become a better company, but it is more around the change of business model, which could be, the difference between contractors and employees. I don't know. I have not looked at, I'm not an accountant, so I've not looked into the details of what could have happened there. Probably I may not even understand that. But the fact which is important as an investor to know is some of these growth of 49% and growth of 8% in a take rate is not because Uber has suddenly become a much better, much well-oiled machine, become much better in their operations, in managing their cost, or are able to negotiate much better rates to the restaurant. None of that had happened. Okay, majority of this came from business model change, which will taper down after 1 year. Right. So then I will wait for another couple of quarters to see how the operations perform. Okay. Other thing, Mover also has a membership. I've never tried it, but they had something called Uber One, and they have almost 12 million members. Again, I think Lyft also has it, but Lyft declined, or they didn't give us the numbers of how many members do they have in their membership program. Right? But from Uber, the number of users have actually doubled in prior year. Right? So this becomes your recurring subscription model, wherein these members pay, I don't know but probably they pay monthly fee. And, once you have an Uber app installed, once you have okay, so Naresh said these are all free membership to credit card holders as a benefit. That's fine. The credit card company is giving you that as a membership, but then Uber still will take some money from credit card company. So, but month after month, you'll get you or whoever, your bank will be paying those dollars to Uber. And we love the subscription dollar coming in, membership dollar coming in, right? 24/7, is it 24/7 Fitness or Planet Fitness? One of them, whichever is a public company, right? If their users start to use it, they'll actually run the company in the ground. They don't want their members to come into the gym. The reason is, I think their gym membership is just $10. People sign up for it and never show up. And, just $10 keep coming in. Just keep getting those $10. I don't know what the Uber's plan is, but I think it's good to see their membership growing. More importantly, and this was a surprise for me, and I do want to keep an eye on it for future, is they have an in-app ad. Maybe I need to take more Ubers. So they have advertising, which I'm like, oh, that's an entirely new revenue stream. And that exceeded to $500 million, right? Still not a huge number, but from nothing to almost $500 million. They have 315,000 merchants who are advertising on Uber platform. Isn't that great? And Uber can actually force you to do that, right? You're trying to, and now I'm thinking, I have not used it. Maybe I should go and use an Uber app and see how the ad appears, where does it appear? But if any one of you, if you have seen that, want to share the experience, please come forward. But my thinking is, if I'm sitting, I want to add a hail an Uber, call for an Uber, and by the time they show, you know, finding a driver or finding the best route or whatever, locating the driver near you, those 10 seconds, they have my attention on the screen. Use that 10 seconds to show that. I don't know if this is what they're doing, or maybe it appears somewhere below. But I think when you're interacting with an app, they have your full attention, and our interaction is for, it's a very meaningful when intended. It's not that like YouTube is playing on the side while I'm working on this document. That generally happens on Friday evening when I have to prepare for, you know, today's session. I'll have something playing on the YouTube on the side. Some songs or something will be playing up on the side while I'm working. And when an ad comes in after 5 seconds, I'll say skip ad. But on Uber, you know, you are pretty much engaged at that point of a time with the app. So I never knew about their advertising, but it's good to see another revenue stream from Uber. So this is why I hold Uber shares than Lyft, because they got multiple revenue streams. Okay, quick look at a balance sheet, almost $9.2 billion. I have no concerns. I looked at not much of debt also. Now looking at a cash flow. If you look at overall cash from operating activities, negative 107. It is still, let's say year ended 2022. No, this quarter, they burned $244 million in a cash flow. So still is setting cash on fire. So is it a business that has become stable? Is it a mature business yet? No. Don't get me wrong. I mean, I like the result, and I own the stock, but I do know that it is still putting wads of cash on fire. And some of the concern which I will have here from an Uber perspective is, because you had your best quarter ever, and if you still can't be operating cash flow positive, then when would you be? Right? If this is your best quarter and you're still cash flow negative, or saying, you know, even with $482 million of stock-based compensation, you know, assume that every employee will have to pay cash. This cash flow becomes almost $700 million cash flow negative from operating, right? So these are the couple of concern I have. Is they're still burning a lot of cash. Okay, they do have a nice cash cushion in their balance sheet, so probably can afford to burn, right? Or maybe if the market will improve later on in a year or two, they could do some secondary. Again, we have to keep an eye on what their balance sheet would be and raise more cash. But right now, they're still burning cash. They have to figure out, you know, how to reduce their expenses. Net profit, as we talked, that's an eyewash. It is from their equity investment and not from from operations. But it is the only player remaining in the game. Lyft is having very tough time. So my guess is they will figure it out. Dara is a very seasoned CEO, and I'm willing to give him more time. Right. What I liked was Fred businesses picking up. Advertising could be a new source of revenue in future. Just like advertising, just like YouTube became for Google, Alphabet, right? No one talked about YouTube prior to 2019. From 2019 onwards, we started seeing YouTube started to add meaningful a contribution to, you know, to Google revenue. Apple did with services, right? Amazon did with advertising, right? No one relates Amazon with advertising, but this is when you start looking at their balance sheet or their earnings to see what they're doing. And now advertising is, we looked at Amazon results last week, what $6 billion? Probably more, right? It's a good revenue for Amazon, good growing revenue stream. So advertising could be a new one. We don't associate advertising to Uber, right? It's been flowing under the radar, and they generated this quarter. Was it this quarter $500 million? Overall revenue run rate for exceeded $500 million. I don't know if it's quarter, but in any case, numbers apart, the fact that they have figured out a new revenue stream that's more important to me. Yeah, so I will continue to be shareholder of Uber. What's my sentiment on this one? I'm still bullish. Earnings surprise investors positively. They have now 2 solid quarters in a row. I like that freight is picking up, advertising is picking up. I'll keep it in portfolio and I'll build my position on it. Right now it's approximately 1%. So yeah, not too big. And time to continue build position on Uber. That's on Uber. Asif says, yes, I keep getting 6-month off offer every year and use it to save 5% on ride. That's probably, I think, to Uber One, their membership. Yeah, so I will have a chance at the end of this month to use Uber. So maybe I'll explore Uber One. Cool. Any questions on Uber? All right, which is the third one that I had is, so we did Uber, we did Lyft, Walt Disney, Mr. Mickey. All right, so Walt Disney is a company where I had my roller coaster ride when it comes of my investment, bullish, bearish, gone back and forth into different camp. Notice they didn't mention anything about abroad operations. I think they did, but I'm not sure if it was, probably I didn't. Let me hold on. Let me pull up their slides and see. Uber, right. We are looking for gross booking, revenue, take rate, geographical region. So there, I'm not sure if you're interested in any. So United States revenue increased by 38%. Europe, Middle East, I think this 110% is driven by this whole UK change. That's probably, I'm sure. I don't. 38% seems reasonable. Yeah, so UK business model changing, impacting revenue. Okay, so yeah, so yeah, they do share in terms of the geographical breakup. Yeah, but I think only thing that caught my eye was this 110%, but then I realized it says talk about Europe. So probably related to those business model changes in UK. Okay. Let's talk about Walt Disney. Sorry, anything else on Uber? All right. Okay, I don't know why. Okay, so their financial year is different, just like Microsoft. Guys, why cannot all the companies just use one financial year calendar? Microsoft have their own weird financial calendar. Disney is in now Q1. All other companies are Q4 2022. And maybe I shouldn't complain. My own company's financial calendar is not a no, financial year is not a calendar year, so why should I complain? And we have sometimes we have to explain to customers when I'm talking to them and say, oh, this will come in Q4, and they say, oh, so you'll come in Q4 by end of December. I'm like, not end of December. Then we have some interesting conversations. So yeah, I shouldn't complain about it, man. Anyway, coming back to stock market, Disney revenue grew 8%, EPS also increased, which is what market would want to see. What I want to see is to their segments, right? Generally, that is more important. So if we look into the segments, Disney Park experiences and products, this is where you go Disney World, Disney World and Disneyland in California, Disney World in Florida. That is up 21%. I'm not surprised. Everyone wants to go out and have more in real life experiences. So the whole 2022 theme has been IRL. People want to go out after, being stuck at home for 2 years because of COVID. So no wonder that parks and experiences is up 21%. Media is only up 1%. So we should see what's happening on the media front. So let's dig deeper on their individual segments. So media, linear networks, which is their cable, down 5%, direct consumer, mostly streaming, is up 13%. This I want to see is the reason why we did not see such a big growth on the media side is international channels. International, they were down 21% in the revenue. And majority of the impact is coming from the cricket tournaments in, I would say, India, Asia were impacted for this quarter, because that looks like as compared to the previous quarter, that some dates have moved around. So they didn't get much of the advertising revenue, and cricket is big in Asia and in that part of the world. So they did see a lot of decrease in revenue because of cricket tournament or lack thereof in the quarter that they reported for. Other big business on which a lot of Disney valuations was based on is Disney Plus streaming, right? Whole 2020, 2021, 2022, only thing that market focused on was how is streaming doing? What are you doing with the streaming? Because that was the latest business that Disney went into a few years ago, and challenged the 800-pound gorilla Netflix. So far they have been doing great in terms of their subscribers, but this is probably the first time actually Disney lost subscribers. Didn't gain, but they lost subscribers. And also running Disney Plus streaming is not easy, or is not cheap. I mean, it costs them a lot. Okay, so this was, if you really look at it from a number perspective, doesn't bode well, because they lost subscribers, and most of the subscriber loss, again, unfortunately, was contributed by the same weakness in their Asia market. Through, I think most of the subscriber loss came from India, around 4 million or so, because of the changes that Disney had done. So in Hotstar and the Disney properties, so they added Hotstar. I think at least in the US, they've added Hotstar under Disney Plus Big Bundle. And I don't know exactly what they've done in India, but they saw a lot of, it became more expensive for subscribers to have Hotstar, and around 4 million subscribers didn't renew. So also, I think Disney raised the price a bit. So that's another reason why some of the subscribers didn't, want to continue with the Disney. So overall, but they still have 164 million subscribers. Sorry, 161 million subscribers, which is not a small number. It's still a good one. So few comments from while looking at this is Bob is back, not the Chapek one, but the Iger. So he is back now for the second time. I think second time only, not like Howard Schultz. So the previous CEO has been let go, and we got Bob Iger, who had run Disney very successfully in his previous stint. I think maybe 15 years he was a CEO, and markets loved him. He's back. He's also focused on cutting cost. So there's done some changes in Disney to cut cost, both for content generation on Disney streaming, plus also on the parks side. So overall, if you look at, they're looking to do $5 billion worth of cost savings, $5.5 billion worth of cost saving is what they're targeting. And whenever any company is talking about cost saving, markets like it. The laying of 7,000 people is, it's never a good feeling for those who are impacted by it. But right now, this is what we are seeing in other sectors also. Companies are focused on cutting costs and shoring up their profitability. Right? Also, what Bob Iger, probably I think after a quarter or two, we should just say Bob. Right? Chapek will be a forgotten episode by then. So he's going to bring back the brands and the creative side in charge. If you recall, a few quarters ago, when I had initially talked about why I had become bearish on Disney, it was because of some of the changes that Mr. Chapek had done in running the business. So he had tried to centralize the decision making rather than having so earlier it was more decentralized. Each of our individual business owners were kind of the CEOs of their own business side. And to cut cost and to streamline, Bob had kind of centralized the power and the decision making. And now we're going, one of the concerns that I had was, guys, if your head is not on the line, and you're not, making in charge of making the decision and also be responsible for that decision, then that's not the best place to have as a head of that department. So Bob Iger is changing it back to how it was, restructuring it and bringing back and making those those heads who were in charge of brands, the creative, giving them more power, which is a good thing. Okay, there are a lot of other things that we discussed with Bob Chapek. I'll not go through all of them. He's no longer here anyway. Also, Disney has suspended their dividend during COVID, and management hinted that they may return to modest dividend by end of this year. So we'll see. Again, I'm not bullish on stock just because they may return to dividend, but there are a lot of other changes that they are focused on. And now CEO succession. This, I think, is becoming more and more pronounced and is being also weighing more on Wall Street is CEO succession, right? Great companies, great CEOs. What happens if those CEOs are no longer in a position to operate? We ran through the same crisis with Starbucks. The Starbucks CEO came back for a third stint. Now let's see how the new person, Lakshman Narayan, is going to do. I think he's going to join in April. But the biggest challenge for Starbucks right now is their CEO succession planning. You can't keep going back to the previous CEO and say, okay, now you come back and save us. They already did 3 times. Disney did the same stuff, gone back to Bob and say, okay, guys, you have to come back. Can't do that. So that's a crisis that Disney has to fix. They got a Nike ex-CEO is as an executive chair and is in charge of success planning. He had done that successfully when he was CEO. Then he did a very successful transition to the current CEO of Nike. So hopefully, let's see, he does a better job. It does a good job in Disney, but time will tell. Another company where we are seeing this problem is Salesforce. Excellent company to own over the last 2 decades. Probably the first real SaaS company. I mean, Salesforce defined this whole SaaS space. Charismatic CEO. Markets loved it. But right now they're running through what's the life after Benioff, right? The company continues to survive. CEOs come and go. But Benioff is also founder CEO. So right now they're running into that crisis. They tried various models. Salesforce has tried co-CEO model 2 times. But they continue to see churn in their top leadership. So that's a crisis brewing up over there. So I think at least over last, I'm seeing more and more, these big public companies. One of the issues that they're grappling with is CEO succession planning. And I think Wall Street is paying attention to this particular topic. Okay. So that's all on Disney from their earnings perspective. The market also reacted positively to Disney earnings. It was up 7, 8, whatever percent. I don't know. Let's check this. Negative 1.27%. Okay, I think it opened up 8% higher from 110 to almost 119. And then eventually, along with the rest of the market, the weakness, we saw Disney also coming down. But yeah, let's see, maybe the Bob Iger can work his magic once again and can repair some of the damage that was done by Bob Chapek. So that's on Disney. All right, any questions on Disney? I think, all right, let's move on to the next one. And there's the last one for today's earning is PayPal. Okay, so we'll talk about PayPal. Again, all right, so let me come here. I think this is rather than going through the text, this will be a better way. All right, when this comes to PayPal, I don't have to explain what PayPal does. So there are 435 million active accounts, which is up 2% year over year. And with the transaction payment volume is up 9% year over year, which is what the amount of payments that's being transacted. It's 1.36 trillion. $27.5 billion revenue for the full year and $5.1 billion for cash flow. Right? So from a business perspective, I think they have done okay this whole year and as well as this quarter. I have no concerns from a business perspective. Quarter-wise, the revenue grew 7% and total payment volume grew 5% in this quarter. Overall active users are 435 million, which is a miss from what Wall Street were expecting, but I think it's still a decent one. So PayPal have had some challenges in the past in terms of how they were, their guidance in how they, had to go back on their guidance. But I think now they're trying to go back to do the right thing. Okay. Now, so we looked at all that financial year. Also, I want to jump into this one. Is there's some of their strategic initiative is one is buy now, pay later. This is one area which I'm watching very closely because especially in the countries where BNPL has been around for some time, after the initial hype, it doesn't work on much. So one area of concern which I'll have on PayPal as well as the other stock that I hold in my portfolio, Square, is their foray into BNPL. Square had paid heavily for their Afterpay acquisition, but this is a space I want to watch. Is how successful can this BNPL be? I have my concerns on it, but this is not a big it's not a big part of their current business, so that's fine. What else did they? They also tested and onboard new merchants to a simplified in-app checkout. I like that. New PayPal reward program to the digital wallets. Again, this is probably going towards, I didn't see them talking about the super app anymore, which is what PayPal had done in 2020. They talked about building a super app. Right now they've toned down, on that one. So over the past few years, if we look at from 2015 to 2022, 2017 to 2022, pretty decent numbers. Agreed that they're not growing at 40%, 16% CAGR is not bad at all. So I think from that perspective, business still doing okay. PayPal is when it comes to acceptance at merchant, it is almost 3 times higher than Apple Pay. So they have a huge lead on as their acceptance on the largest retailers in North America and Europe. So they'll have to just continue build on it. Yeah, I want to keep an eye on BNPL. It might be just a fad. Who knows? But we'll have to see. So overall, BNPL transactions were 147 million transactions, and 25 million customers. Right. Few things to note. Activist Elliott Management, he took a stake, I think, in last to maybe previous quarter or quarter prior to that. So some of the changes that we are seeing in PayPal, the biggest changes now, the CEO is going to retire by end of this year. He's already 65. And so at some point of time, we should start to expect that, you can't have octogenarians as CEOs, though Berkshire still have nanogenarians as their CEOs, and they are still doing pretty good. But I would say those are exceptions. You don't have Warren Buffett and the likes of him in every company. But so Dan is already 65 years age. He wants to do something else in his life. And also recently, we had some goof ups from PayPal. In October last year, they tried to acquire Pinterest and wanted to pay $70 or was it $70 billion worth of market? Hold on, where was that? Oh no, $70 per share is what they were willing to pay to Pinterest. Today, if we look at Pinterest, right, it's $27, right? We looked at the Pinterest results. It's $27. So that was one goof up, then they had to abandon it. The other one is they misjudged the market. So in 2020, they announced 2 programs. PayPal, one is, of course, they want to become a super app. just like WeChat. And they had a program of 750 million users, 50 billion revenue, and was it 25 billion of free cash flow or 15 billion of free cash flow? I forgot that. So they had these three metrics by 2025. And then, after a couple of quarters, they say, oh, sorry, ignore everything. Whatever we said around our 2025 target of 750 million, $50 billion revenue. And market punished PayPal shares during that. So no wonder the shares, it used to be a $300 billion company. And now where it is $89 billion. Right. And if you look at some part of time, it was trading at $280, from $280 to $80. Right. So it's lost 70% of its market cap. So I think market is looking at someone new to come and make changes to PayPal. Elliott has been pushing for these changes. So we'll see. Again, I think that the space of in which PayPal operates, in which Square operate, Visa, MasterCard continues to grow. And I think if they do the right things, there's still a lot of runway for these companies. Right? So I am a shareholder. I'll continue to hold my shares. Those shares are underwater, but sell premium, reduced cost basis is what we're going to continue to do on PayPal. So that's on PayPal. Yeah, the latest one which I saw looked like they announced yesterday was they also wanted to work on stablecoin, but now they're saying, okay, no more. We are shelving that plan also based on whole this week's regulatory crackdown on on many crypto companies. So PayPal they don't want to get into the eyes of regulators right now. So they are like, okay, we're not going to work on the stablecoin anymore. Okay. See another comment. Activists are circling around CRM, PayPal, and settle with Disney. Yeah, after Disney announced this whole this cost cutting and everything. Not Carl Icahn, Nelson Peltz. I think wasn't Disney was in Peltz. Peltz was pressurizing Disney for the board seat, or was it some other company? Okay, yeah, it was Peltz. Yeah, so Peltz was like, okay, we don't want to fight is over. There's a peace, and Disney has done whatever we wanted them to do. Everything is hunky-dory, life is good. So yeah, he kind of Disney settled with Nelson Peltz. CRM, there's a party over there on CRM, I believe. I think, I know Elliott is in CRM, but I think in the last 2-3 weeks, and again, I don't own Salesforce, so I don't track it so closely. But on a general level, I heard there are a few more activist investors have jumped into CRM. I don't know what the heck is it, like a party for all? Let's find out. Salesforce activist investors. See, they're like, Elliott I was aware of, Starboard I was aware of. Now we got 2 more. So there are now 4 of them are playing in Salesforce. So it'll be good to see. Oh no, even Third Point. I think this is the latest one. Third Point came in from Dan Love's. Third Point is now the 5th activist investor in Salesforce. Wow. Yeah, we'll see what happens in terms of these 5 activist investors. Who wants what? Will be interesting to watch that. All right, that's all on earnings for the prior week. Next week, what are we watching? I want to keep an eye on Palantir. Let me see what else. Airbnb. Roblox, Shopify. Don't have Roku anymore. That's a part of ARKK, a trade desk. I want to see how their UID is doing. That's more important in trade desk. What's the adoption of their UID? Palantir, want to see the difference between their government and commercial revenue. Shopify, want to see how they're more traction with their merchants catalog, something that recently, new one that they had introduced. And what else? Log, SunPower, Datadog. This company has been on my radar for some time. Never pulled a plug on Datadog. Anyone holds Datadog and can talk more about it? I mean, I read once about Datadog in terms of the multiple products. So I think I should maybe pull a plug on Datadog sometime. But again, I don't want to add more ticker to my portfolio. I have to then remove something from my portfolio to make space for Datadog. DoorDash, not interested. Applied Material. Redfin, not interested. Yeah, I guess a few one. Or maybe look at Redfin. It's been beaten by a lot. But there are, only few property tech companies. I mean, Zillow, Redfin. So maybe we'll look at what Redfin has done. Are they bouncing back from the the storm route that they had? Ramesh is saying DE, John Deere, Caterpillar, Arista Network, ANET. Okay, that's ANET. Yeah, I don't hold positions on any one of them. Yeah. All right. So that's next is going to be a little like, that's okay. Can do a lot more other stuff. Okay. Anyone else have any stocks you're watching for next week, at least on the earnings? Oh, AMC Networks. Is this the same as those AMC meme stock? We'll have to see what happens to this. All right. Okay, let's oh, it's not the same AMC. Okay. Then ignore it. I don't even know what the meme stock AMC's name is. All right, let's do, and probably the last session. Let's see what we want to cover. Okay, yeah, let's cover this one and then we'll call it a day. Is oh, this is AMCX. Okay, I have no idea what this company is. Let's see and go back and understand what had caused that failure in NYSE prior Wednesday, right? Oh, TV channel. Okay. So before that, it is important to understand how the little bit stock market operates and what had happened, because I was surprised that suddenly the stocks were halted, and then first thing I did was go to Google and see, is there any news coming out from the stock? I did not see any news from the company, news pending from the company, because generally you will see either the companies have asked the holding because they want to announce something, or sometimes you see that it will hit those upper and lower circuits. That had not happened, and it was all talking about something opening price, and I thought, what the heck is this? Right. So as a participant in the stock market, it helps us to understand some of these nuances on how the market works. Something different to learn, something different to know than just the stock is the dealing with how the market has been. Simon said, do you or have you been to Disney parks? Yes, I've been to Disney park, but not in recent years. I think my kid has been to Disney park last year through her school, but I've not been to Disney park, let's say, in 6 years. 6 or 4. When we did last make a trip? Yeah, maybe 5, 6 years. All right. So what had happened? So before that, let's understand what is the stock market, what happens in stock market. So in a stock market, very obvious, a lot of people and a computer want to buy or sell a stock, right? A lot of people want to buy a stock. A lot of people want to sell a huge amount of stock, but they may not always be at the same time. Most of the time, I want to sell a stock now, and maybe you want to buy it, but you don't want to buy it now. You will place your buy order later. So in theory, there are 3 ways that you deal with it. One is, if I want to sell a stock, I could just wait. Or if I want to buy a stock, I could just wait. I can put an order for 1,000 shares, and then I can wait and see who is willing to sell those 1,000 shares, and then we trade with each other. So it's just like a marketplace. Exchange becomes facilitator, and sometimes it might take minutes, hours, and sometimes it may take days. I may not get anyone who is willing to sell those 1,000 shares. Second way is there are market makers. And this is where mostly in the US, this is how it happens, is you have a market makers whose job is to make the market. Say, if I want to sell 1,000 shares, they'll buy it from me. I don't have to wait. But that's how in the US market, the moment you, put your shares for sale, they get executed immediately because they are market makers. And this is where when I hear from people saying, hey, I am selling it, if someone is buying from me, why is he buying from me? Right? Or if I'm buying it, someone who's selling me knows more about the company, that's why he's selling. So then why should I buy it? No. In US, especially, most of these trades are managed by market makers who have zero idea about the company. So if you are bullish on a company, don't hold yourself back thinking, so someone who is selling probably knows more about it. Someone watched it from his selling, and that's why they probably know more about it. They don't want to hold it, and hence they are selling to me. And I don't want to get suckered into it. So, don't change your opinion about it. And really, I've heard people talking about this thing, saying, why do you want to buy it? If you don't watch it from me selling to you, they probably know much better things than you. No, that's not how it works in US. There are market makers whose job is just to buy and sell whenever you want to sell or buy. So if I want to buy 1,000 shares, they'll sell it to me. And of course, if someone else wants to buy it from them, then they will sell it to them, make a few pennies or maybe a fraction of a penny on each trade, but they'll do millions and trillions of a trade in a year. Third way, which is what I did not know, and I figured it out after this debacle, was exchange actually get all of us together. When I say us, means not physically, but what exchange says is, okay, whoever wants to buy these Wells Fargo 1,000 shares, we're gonna do a big swap of the shares at 9:30 a.m. tomorrow. Send your orders and we'll match them up, and have people trade at that point of time. So this is what is called as a opening auction, right? Which happens on exchange. So we'll dig deeper into that. But before that, few other good, nice things to learn about is this method 2, which is market makers. How that market makers even happen, how does that behave? So I'll not read through all of them, but maybe just give a gist of the way in US it works. And someone who probably is more into day trading would probably know a lot more than what I could understand from what I read. So feel free to jump in and help all of us to understand how this works. But the way the market maker firms work is through a central limit book order, right, called CLOB. So the way CLOB works is market makers will come and post the limit on the exchange saying, I am willing to buy this, I'm willing to buy the Wells Fargo shares at, let's say, 44.99. I'll buy 100 shares of 44.99. I'll buy 500 shares at 44.96. I'll buy 1,000 shares at 44.90. So it's not, there's a single price. There'll be a different pricing and you'll see the lots. And I think some of the trading platforms where you can see the order book, and maybe now I should go and look at that. Probably then it makes sense. If you look at the order book, you will see, this is level 2 data. You will see those order book in terms of 100 shares are available at this point of at this price point, 200 share at this price point, and that's a order book, which is central limit order book, is market makers will populate. So if you want to sell 1,000 shares, your 100 shares will get executed, let's say 44.99. 200 will get executed at 44.98. 300 will get executed at 44.95. So this is called, it goes through the order book, right? Now, sometimes we see that fat finger, etc. happens. Is what happens is someone will put in a sell order of 100,000 shares and doesn't break it into small orders. But if there's someone immediately put it under, to sell 100,000 shares, it just run through the whole order book. In that case, it will sell 100 shares at 44.99, 200 at 44.98, and continue to go down. And it might end up in some shares which get sold at $20. And this is generally what is referred as finger trade. Somebody forgot to break up this 100,000 shares trade into maybe 1,000 lot, maybe lots of 100, and have it run through over a period of time and not exhaust to the whole order book, right? But sometimes people forget to do these things. And these are the cases wherein we will see a huge jump or huge, share crash momentarily, because someone just hit it and it had just gone through all the pricing of the order book. So this is how the market makers post their pricing, their orders in the order book. And when the trades come in, they're willing to, do the trades at those prices. The third one, where is the auction, is also important. And this looks like happens every day. When a lot of people want to trade at the same time, US market opens at 9:30 a.m. to 4 p.m. Eastern time, which is 6:30 a.m. And I love that because, hey, this is before your regular day job starts, so I can do something in the morning before my work starts. So the rough idea how the auction happens is everyone who wants to buy or sell, you put in your open or a close orders, in a minutes leading up to 9:30 or in a closing auction. So right now we focus only on opening auction. So some of those are market orders. Some of them could be limit orders, right? And then the exchange will find a price that matches up with them and as an auction price. So why this opening auction is important? Because in US, crypto market is 24/7, but the stock market goes to bed at 4 p.m. every day. And then it wakes up at 9:30 a.m. next day. Of course, there's the after-hour trading, etc., but that's for a limited, and I'm not talking about futures, right? But stuff overnight will happen. Earning results will come out, news will break, someone get, some litigations will happen, some research report will come out. Things changes overnight. Whatever the stock closed in the morning, it may not open up at the same price. Whatever price the stock closed in at a closure, will not open up at the same price, right? It could open up at a different price. So this opening auction is where the price discovery will happen. Remember, market makers are not there yet at the opening because they have zero idea about what the price of the stock should be. But this might be surprising. The citadels don't know what the price that they should pay for the stock. They are just there. Once the market discovers what the pricing is, then Citadel will come. Let's say market discover the price is $50. Then the Citadel will come and say, I'll buy from anyone who's willing to sell me at $44.99. And I'll sell it to anyone who's willing to buy from me at $50 1 cent. And we'll do it without having any idea about any business of underlying company. So when the market opens, it's not a market maker, but are the real investors, you, me, pension managers, retail traders on Robinhood, those who have set up their value, they want to trade. And that's where the discovery, price discovery happens. Because now you and I, or the traders or the pension fund, they know, okay, I think I want to pay $50 because that's what the worth is, not the market makers. So when all these real buyers, they come, and when are matched together during the auction, that's when the price for that stock is set. Talking about Wells Fargo, that's when you know, okay, Wells Fargo is worth $50. Okay. And it happens for a fraction of a second because everything is automated in computers. This whole auction is automated. And then a millisecond later, market makers will come in and start to populate the order book. Now, what happened on that Wednesday was there was some system, not a system error, but for whatever reason, I think there was a disaster recovery system which was left open. For whatever reason, the auction did not happen. The morning auction, opening auction, there was no auction price that was discovered. So when the auction price didn't happen, I don't know where it says. Okay. So yeah. So when the auction price did not happen, and then a millisecond later, market makers did not know. I mean, at that point of a time, when the initial auction price doesn't happen, so what happens to all the orders that have been put in, right? If there is no auction price, then it goes to the order book, which is a central limit order book that we have looked at. Now at 9:30, there are hardly any orders in the order book because market makers have not populated that order book because they were waiting for the auction price to tell them what's the right price, the price discovery to happen in the morning. So if there were some old orders placed in the order book, and if a big order has gone to that order book, it had a wild swings in terms of the initial trades that had happened. Right. So that was essentially what caused this huge glitch, or I would say huge swings in those almost 200 stocks, because it's like completely illiquid market. At this point of a time, the order book was empty. So market makers were waiting for opening auction to populate the order book. And if the auction doesn't happen, trading has already started. And then there is no one to buy from the seller and no one to sell to the buyers. And so right now, the order book is so thin that if you want to buy like 500 shares, it could make a huge jump in the prices. And that's exactly what had happened. So, and technically, there was a glitch on the NYSE which caused issues in having the opening auction price for some 200 stocks. And then we saw huge movement in those stock prices for a fraction of a second until that, or maybe for the time until that issue was resolved. And then basically NYSE had to halt the trading on those stocks. So that's essentially happened. So for me, it was a exciting way to read through and understand what I never knew about this opening auction, but it was a good to understand some of these workings of the market and what's this order book, how does that get populated, and what exactly happens. So thought I'll share with you. So something new that you learned is central limit order book, which is what market makers populate, and that's how it works. Where it gets, this is on Bloomberg. If you Matt Levine, very well respected columnist in Bloomberg, he actually, in his article, he wrote the whole detail of why NYSE slept. Hold on, see if I can just bring that up. So NYSE slept. Matt Levine. Yeah, I'll share the link. NYSE forgot to open on Wednesday. Okay. Now you can read it in detail. I think plus he also talked about some other things. But yeah, it was a fascinating read to understand some of these mechanics of how market works, how price discovery happens, and what happened to NYSE on the other day. So thought I'll share with you. Now you can go and dig deeper into it. All right, I guess let's stop right here, unless there are questions or anything else you want to talk about. I can be around for another 5, 10, 15 minutes. If nothing else, we all get a few minutes to our schedule. Tomorrow it's a Super Bowl. I don't have any horse in the game. I don't have any team in the game. 49ers were beaten by, I think, Kansas Chiefs. So I think, yeah, I probably, we're just trying to figure out if we're going to go to some friend's place and watch or what we're going to do. Right? No plans, but we'll see what happens Super Bowl. Jesse, is it similar with closing cross at market close? I have no idea what this closing cross. Probably is there a closing auction also on NYSE? Auction time. So because I saw that it's an opening and closing. That's why the opening and closing are heavy. Okay, yeah, so there is an opening closing. 4 p.m. is a closing auction. 6:30 a.m. is an opening auction. So I don't know what its closing cross is. Or maybe NYSE might have more details on this. Okay. No, so it doesn't, this paper doesn't talk about how the mechanics work, but it does say is if you want to place closing order, this is when you should place blah, blah. But yeah, some days I love reading these detailed articles. One which I have yet to read, which is nothing related to investment, but I heard about the Nord Stream pipeline, and there was one article around how US was involved in blowing up the Nord Stream pipeline. One of my friends sent it. Again, everyone has their own views. It was like, what is US doing? I'm like, I've not read this article. Maybe this weekend I'll read that, but that has nothing to do with investing. A little more about Pentagons and what gamesmanship and what US does. All right, anything else? Cool. Cool.
Wait, excuse me.
Yeah, go ahead.
Nord Stream does have to do with investing because I mean, if something really happens at all, won't it kill the won't there be a lot of turbulence on the oil markets?
Oh yeah, I mean, I agree. From that perspective, yes, but I mean, I don't think that I was willing to learn something about the function of our market or Nordstrom as a company or anything. Yeah, because that pipeline is any disruption to oil pipeline will cause a turbulence in energy market. Oh, that was last to drink water. Is that the one? Oh, you're right. The Nord Stream is the one which is in Europe from Russia delivering natural gas to Germany. Oh yeah. So okay. All right. It'll be interesting because that time I think I had covered that there was a Nord Stream pipeline had broken and then it was shut down for maintenance purposes. That's what Russia had told, that we are shutting down the Nord Stream for maintenance purposes. And that point of a time, we all thought that Russia is just using it as an excuse to squeeze, or at least I thought that it's just an excuse from Russia to do a maintenance and say to basically squeeze Europe and bring Europe for negotiating table. Oh, geez. So which pipeline am I confusing? Okay. Oh no, maybe okay. For some reason, I thought it's a Keystone is in US. Nord Stream is that European pipeline. Okay. Oh, then I definitely want to read it. Yeah, there was a blog or whatever you may call from someone, which was basically, yeah, Keystone never took off. So many of our environmental concerns and whatnot. Keystone Pipeline, that's from Canada to here. Cool. Alrighty then. I guess that's it for today. Thank you very much. And yeah, if you have anything specific topic, feel free to ping me on Meetup. And yeah, then I can maybe cover anything specific that you are interested in. Otherwise, we'll talk about the general markets and companies as always. Cool. All right. Have a wonderful day. Thank you, everyone, for showing up on Saturday. Bye-bye.